Alrighty. Hey everyone, welcome back to Investing Ethos, and this is our first video. This is me, ELPASO, and we got Noicewon from Strawman. And we want to just do something a bit interesting, where we're talking about Strawman in particular, and how it's a great platform for new investors. And in this weekly, we just want to go through a couple of topics that we feel are quite important for new investors to come on board. And we thought, why not do a weekly podcast where we talk about some of the stocks we own, as well as looking into some more deep dives and just have our say on what's going on. And I think it's a good way of recapping the week and finding some new insights. So Noicewon, welcome aboard. Can you give me a background on yourself? What made you interested in Strawman and everything?
Yeah, sure. So first started on Strawman after I saw Andrew presenting at Coffee Microcaps in Sydney a few, maybe 18 months ago now. So I've been on the platform since just after COVID, or maybe just before COVID last year. I don't think I actually set up my portfolio till after the market had risen 10%. So that's my excuse for the underperformance anyway. So just graduated from finance at Macquarie University this year. And basically started looking at stocks properly for the last 12 months. So I thought Strawman was a great place to start. That's how we met, and I've met quite a few like-minded individuals that are really switched on and just sharing great ideas. So I think the podcast is a great idea because often a lot of the time to write out some of the long posts on Strawman takes a long time. So especially when I'm driving to and from work, it's the sort of perfect thing just to listen to people talk about stocks, that I'm always looking for podcasts. So I think it's a great opportunity for those to listen and chat about the platform.
Yeah, absolutely, mate. And obviously we're going to be doing both in Spotify as well as doing it in YouTube, so you could see both the visual and the audio. And I think this is a great way for us to interact. And we will have more guests in the future if this becomes something that's sustainable. But let's move forward. So in the weekly, we're going to be splitting it into 4 sections. We're going to start with stock of the week, then a top 10 Strawman stock to discuss, and then we look at the investor of the week that we choose. And it's an interesting investor to choose every week, just to show exactly who is being very active in the platform, as well as who has some very interesting things to say. And finally, we'll wrap it up with some lessons, either from me or from you, that we took out from this week of investing. Because every week we go through phases in the market and we get to learn some things, and obviously painful lessons are a good way of learning. And that was my theme for this week, but obviously there could be some good wins in your portfolio for this week as well. So it's going to be a mixture of both. And now is a good time to let you guys know that this is general advice disclaimer. I'm not providing personal financial advice. I'm not looking at your financial situations and making recommendations with the analysis that I'm going to be doing. This is just me revising my thesis on my prior evaluations and making an update based on new information. So please, if you were to use this as financial advice, please consult a financial advisor who is licensed to provide financial advice based on your situation. I'm not a financial advisor, so please keep a note of that. Thank you. Well, let's start with stock of the week, and I mean, there's no better stock to discuss than Janison, because it's a stock that I've been doing research for more than 12 months, 9 months if you're looking at the OECD contract in detail, but 12 months altogether since I've did my initial deep dive. And you, my mate, I know you have been looking into Janison as well, and so is a lot of chatter in the Strawman platform. So first off, Janison, what do you think about it?
Yeah, so some of your confidence rubbed off on me to have a look at this one. So I've got to thank you for it. I started looking at Janison maybe 6 months ago. I never got as deep into the financials as I should have, and I've obviously missed the boat in terms of the recent share uplift in the business performance. But I sat down and from scratch and went back to the prospectus and had a look at what these guys kind of aim to do. So they've been around for a couple of years now. And reflecting on the impact that COVID's had, I thought I wanted to target a business that's got long-term tailwinds, and the digitalization of education is one thing that COVID has definitely brought forward, and I think will stay around for a while. I can't imagine on a personal level doing an exam in high school writing essays anymore. I just can't. That's kind of within my thinking when I first started looking at Janison, but that's obviously not the ball point of the whole investment thesis. So I always like to map the financials up first and kind of see what we're at. There's a bit of growth priced into Janison, which isn't worrying, because I think the runway for more growth is fantastic with the OECD contract. Obviously, we've chatted a bit about the deal running to 2024, and possibly the market kind of seeing this as a bit of an issue because the stock's not trading on what's the current market capitalization, 180 roughly million. So it's got a bit of growth priced in, but I think that there is maybe a slight background worry just with this contract running out at some point. And if revenues are going to contribute so much from this contract, then what happens afterwards? At a price to sales of 6, like, it's not too bad. But I don't like to use price to sales. It's more of a proxy to see, is the thing super overvalued? No. Okay, good. And I think understanding the OECD contract and the other business that they bought, the ICAS business, I haven't spent enough time on that one, so I think you'd be better to speak about that. But I think the OECD contract's a phenomenal runway, and I'm very interested to see the numbers come through, especially for the UK, Wales, Scotland, and Northern Ireland numbers, particularly because they're the NSP provider there. I think the US is also promising, but for me, with the US coming out of the lockdown with the schools, I think the US and the UK are really promising. Australia has shown some great growth in the 6 months in or less, so they've been signed up. So I think it's a phenomenal opportunity there.
Yeah, and I think you've touched on a couple of really good points for Janison, because there are for those who don't know, Janison is an education technology company that provide digital exams, and these are high stakes exams. So some of the key exams involve entry level exams to universities. So they have had an agreement with the Czech Republic, a university in Czech Republic, where they do the selective high school exam, more like the HSC exam for Australia, but for Czech Republic, where students want to get into universities, they have to first pass this entrance exam to do it, and they digitize that exam, and they did really well. But the key driver for this business is OECD contract, like you mentioned. OECD is the biggest opportunity. There are 90 countries in the world that participate in the OECD PISA for schools test exam. And it's an annual exam, and Janison won this contract against Pearson, which is the largest education provider in the world. So a startup in Australia in 2018, because they bid on the contract in 2018, won the contract in 2019 against a global behemoth in the form of Pearson. And when I saw that, I thought, well, surely not. Like this company that in Australia cannot survive. Because they were burning cash all over the place. But now you start to see whatever Tom Richardson, the previous CEO, did has worked really well. And now the current CEO, David Kaspari, is now all about expanding to different geographies, as well as expanding the revenue opportunity. Because right now, with 90 countries, if you do a rough analysis, which is about 700,000 give or take per country on an IPP, you're looking at about $50 million. And that's not even considering the national service provider, where they get $7,000 per school. And they got the NSP for USA, the UK. UK is composed of
Australia,
and Wales, Scotland, Northern Ireland, and as well as Australia. So you add all this together, even the OECD opportunity is around about $90 million. That's assuming no NSP for anything else. It's just
what's the new countries they've got to sign up?
Yeah, and one of the countries, and one of the countries that is not yet signed up is India, and India is massive, humongous. I think they have more schools than I think everyone else, right? But I'm most likely considering India to be an IPP. I do not think they're going to be an NSP because I do not think they have the network laid out.
No, not yet.
Because they have, I'm not trying to be like, countrycist, but like, Janison is an Australian company, and that's why the agreements that they have are with like Western speaking, English speaking nations.
Yeah, makes sense.
Well,
Yeah.
but in saying that, they got China, they're an IPP there. There's a lot of growth opportunities for them, and I think what's really great about this company is not only just that one contract, but the potential partnerships that result in it. So they have a partnership with the D2L Brightspace in USA to grow the PISA-based test for schools exam, but obviously they can do for other tests as well. Same with Benesi in Japan. Benesi is a massive provider of exams in Japan, and they not only do the PISA test, but they could do other tests as well. So in a way, that's what I kind of feel happy about as an investor, as a shareholder, is because they have optionality with the partners that they have on the platform. But obviously, Reese, you're right. 2024 is not too far off, and that's when they have to renew this contract. And if they do not pass, and if they do not, succeed in getting that, then there could come a risk where they lose all these customers, right? That is a genuine risk for shareholders, but that's a 2024 problem, like I put out in Strawman. But what I'm saying is that with this company, it's really important for you to understand the prospectus, really read that through, really understand the contract itself, because there are two different agreements that are there. And I feel with Janison, you got to do your research. There's no shortcuts on this one, because they have opportunities to do multiple exams for multiple different types of providers. But the margins matter at the end of the day, and that's when you have to do your DCF and see what the fair value is. And at this stage in Strawman, I put a fair value of $3.60. That is assuming a very, very bullish scenario where they get $200 million in 2024. Very likely, but it can happen if they manage to hit certain metrics, and especially with the US schools, with the reopening, and also with the funding, because the Biden government increased funding for the CARES Act, which goes straight towards schools. This open up an opportunity.
Same in the UK.
Yeah, open up opportunity for Janison. And I think what's also not mentioned in that contract for the expansion in USA is the commission that goes towards Brightspace. I think they're going to announce that as well, because I would not assume that Janison gets all the revenues, even though
No, neither. Yeah.
They could probably get have to pay 30% commission or something. That's what I was thinking. But it'll be interesting to see how this company progress throughout time. But I believe this is stock of the week for sure, because not only me discuss it in the platform, but you also discuss it as well. And I know you're building a model out of it, and you're talking to multiple people, including myself, to get the best information. So I think this has to be stock of the week for this week. Yeah. So also regarding Janison, what is your latest research now? Because I know we had a discussion beforehand. Have changed in your mind? Are there things that you're considering?
Yeah, sure. So I'm in the process of, I've put the model together, and I've kind of reviewing what I'd made at first. I was a bit bullish on the margins. In my DCF, the one thing I've done different to you is not expanded the cash flows out over 10 years, but over a shorter period, which I think is definitely very sensitive to inputs. And obviously we know a model is only as strong as its weakest input. So right now I'm not confident enough to put a valuation I'm going to stand by on a Strawman. I think my DCF puts out something like a $2.50 valuation, but that is really banking on the success of the OECD. And I think in the range of possibilities and outcomes as an investor, we want to know what the percentage chance, this thing loses out in the OECD contract in 2024, and what happens then? And I think if knowing that in 2024 that the contract wasn't going to get renewed, as a shareholder, not as a shareholder, then I definitely wouldn't buy the stock today. And if I was a shareholder, I'd probably consider selling the stock, because other than this OECD contract, I'm not 100% sure that $90 million revenues can come from anywhere else. So there's nothing to flag at this stage. But I don't think that will be the case. And I think being able to speak to the CEO in the next earnings call and clarifying that information will be so powerful. And I know you've mentioned that before, and someone else on the forum was also mentioning it.
Yeah,
in terms of
and
valuation,
also,
sorry, go on.
Yeah, and also one final thing with the ICAS exam. That exam was I think might be the most genius acquisition that I've seen. Short time investing, like
Yeah,
$700,000 buying out an entity for UNSW Global that generated $5 million in revenue in Australia. But the reason why they managed to get at such a cheap price is because whoever was running it in UNSW Global really screwed it up due to the pandemic. It was a physical exam, a paper-based exam, and because of the COVID crisis, they just lost all that revenue. There was
had to offload it. Yeah.
Yeah, but Janison did. So Janison did the test online, the ICAS exam, and they successfully did it, and they managed to get $5 million in revenues. So for a $700,000 spend, they got $5 million back, which I think is one of the most smartest things that they've ever done. And it's a 90% gross margin. So all of that is to the shareholder,
bottom line, yeah,
to the company. It's which I think is still one of the most smartest acquisitions I've seen. Very like the timing of that was really good as well. It was done like in May, right when the pandemic hit. So they got it at a really nice bargain. Also, what do you call it? Their plans for the ICAS exam is to do it globally, and they assume that it'll be $15. It's a $15 test. So they're going to do 1 million tests globally, which means $15 million in revenues long term. And in my Strawman posts, I recently put out that what about expanding it not just for English, math, science, but for other subjects like programming, history, or any of the arts? Would that increase revenue? That could be an interesting question to ask actually in the earnings call, because I think they have hinted around expanding more subjects, but what would that mean in terms of ARR? Like, would that increase from $15 per test to, like, I don't know, $30 a test? And it wouldn't be that bad, because by increasing the prices and you keep the cost the same, you're getting more back. You're increasing your margins. But obviously, that's, like I said in the forum or in the comments or whatever, that is my wishful thinking. But if that was to be true, then, well, Janison just got a whole lot more lucrative for investors. But obviously, we remain to see how that pans out.
Yep.
Yeah. So that's the stock of the week. Let's talk about a top 10 stock in Strawman. And I mean, we had to go with Alcidion. The reason why we choose Alcidion is because both of us are invested in it. So the first one, Janison, I was invested in it. Reese, you weren't, so you missed out on the boat.
Sure did.
But this one, we both invested in it. And I think we both making very similar returns. But I made the idiotic decision to sell a bit early, as I put out in a straw that I was a bit too early. I jumped the gun there. Right now it's at 45 cents. So I think the market cap's like in the 300 millions, right?
Geez, let me get my model up. It's pushing on 400 now, I believe.
Oh, 400. Holy crap. Okay.
Yeah. Just with the new.
I sold my 7K stake in Strawman just to, try to increase my return on the long run. But I think I was a bit too early on it. I'm not going to sell anymore. So I'm just going to ride out with what I have. But interested to know what your take on Alcidion.
Yeah, sure. So I've been a shareholder in Alcidion for a long time. I think I first heard Alcidion on this platform. So it just shows how great it can be. I'm not saying every stock that gets recommended on Strawman has done well since, because that's obviously not the case. But I first heard on the Equity Mates podcast, I think it was Andrew talking about Alcidion. So I started doing some research. I understood that Alcidion have got like a next level product in the hospitals, but there's several problems. And a good business doesn't make a good investment. And at the time, the risk to reward probably wasn't great. And since then, they've done amazing. Kate Quirk and the team have just won over a lot of contracts in the NHS Trust in England. And there's no sign that that's going to slow down. I'd imagine they're going to upsell and cross-sell with a new acquisition of ExtraMed. And that's when I was quoting, sorry, the market cap now at a share price of 44 cents is, just 1 second, is closing on a 500 mil, which is a lot because these guys aren't actually profitable yet. Unlike Janison, are actually very close to crossing the inflection point, if not have crossed it. Whereas Alcidion, I think, is going to take maybe a couple more. They were profitable in the most recent quarterly, but I think with the new acquisition and they're going to put some spending forward, I think it may be yet to foreseen to see this sustained turn into profitability. But I think, like I said, with this stock, it's a cracking company, but the share price of 44 cents or a market cap of 460-ish million, it's got a lot of growth priced in, maybe 20% for the next 4 or 5 years. And if they don't meet that, then the stock is going to be hurt. And then for you to buy it at this level, you've got to then anticipate that they're going to maybe do a 40% CAGR with a margin of safety, or a 30%. And that's asking an awful lot. As an investor, the price you pay is always one of the most important things, if not the most important thing. Because every good company, I think it's a Howard Marks or a Buffett quote, every good company becomes an unattractive investment at a certain price, and vice versa. Every bad company becomes attractive at a certain low price. I think with these guys, it's pushing it. So I actually sold maybe a fifth of my holding in real life at 43 cents, something like that. I did say it climbed higher, which is, I'm never going to time the top, so I'm not going to sit here and say that. But I think if the share price pushed above 50 cents on no more good news, I would definitely consider selling down again, just on valuation concerns. I think the company's doing really well, though.
I agree. But except for the sell down, because I already did sell down, so I do not want to sell down further. That's for me. But I agree with you regarding it's a great company. It's run by great management. I was skeptical in management when I first saw it. I just saw it, I think, 1 or 2 times ago in 2019, late 2019. I heard about Alcidion, but I didn't really go into it. I was thinking about investing, but then I had to do further research. And then when the pandemic hits and I saw that Kate bought, I don't know, so much shares. I think she bought,
package, yep.
She bought like 1 million shares worth, I think, at like 10 cents or something. I just thought, wow, that's just me. What that told me was that I know that Kate's a great manager, and for her to buy it at that time means that she feels the company's undervalued. And that's when I bought as well. I bought with management, and sometimes it's a good way of doing it, because that way, if the management's wrong, then you're wrong. But because it was already down as well, that's kind of gave me that, that comfort zone, knowing that the valuation is very low as well. But right now the valuation is hitting 500 million, and I don't know how sustainable that is. It's same with Pointera. Valuation is still very, very high. Like I think the 500 million, I think, or 450 million for $1 million in ARR. But we're not going to talk about. This is one of the top 10 Strawman stocks, but we're just talking about Alcidion this week. Maybe next week we can talk about Pointera and get into a better understanding of the company. But literally, Alcidion, the growth plans in the future is in NHS, the UK growth, and there's about 200 sites that are in UK, and Alcidion has around about 20 now with the ExtraMed acquisition of 6 more sites. So it might come a point where they need to acquire to grow, and that can be a bit of a concern, because if they need to acquire to grow, then, okay, yes, they got the site and sort of integration to get more average revenue per user, or in this case per hospital. But it's not a sustainable way of growing, because if they can't raise capital at very high prices, then they can't acquire, right? So that's something to think about, because I'm not sure which ed tech, like which health tech player owns what, because there's another company there. There are many competitors there. I think one of them, I
BKS.
Strawman, but I think I think Nerve Center, yeah, Nerve Center. That's one of the companies that have some NHS trusts that are using their health workflow management architecture. So that competes directly with Alcidion. Alcidion has many products like the Mia and Mia Precision, as well as a smart page. But like Nerve Center have their own products, and they're using it in NHS hospitals and districts. So the question remains: will Alcidion acquire them, for instance, or will they outcompete them and get the site? Because with healthcare, it's a bit hard because it's very sticky customers. Like when you get that customer and then NHS, trust or a district, like they know you like a first name basis, because they wouldn't do the deal until you meet them face to face. In this case, they managed to do it through Zoom, because I think even the NHS realized that because of the pandemic, you can't really meet face to face. That could be great for Alcidion, because that means there's less business trip costs to go overseas. But in saying that, when you get those types of customers, it's a question of the market size and how does Alcidion go about penetrating more in the NHS before they, before they realize that they can't do any more in the UK market and they have to go to US, because that's what's going to happen next. Is once they've done enough penetration, they go, okay, maybe we need to go to a new market to grow. Otherwise, it's just not cost effective. And by then, we don't know what the future will be. But that's why there are some risks involved, and a lot of growth has been priced. But they're winning very unique tenders, government tenders, like the Department of Defense one as well. We do not know what if they win it until they give us the full year results as well. But things like that is what makes Alcidion a very flexible platform. In terms of an ARR, it just adds up. So the way I see it is, whenever they win a contract, we just add that ARR on top and just keep adding until you reach the market size. So it's a very interesting company to analyze, very interesting company to value. But obviously, with my valuation of Alcidion at 37 cents, I feel like I'm giving it a benefit of the doubt, and the market is going above and beyond what I'm giving right now.
Yep.
So
100%.
it'll be interesting to see how it plays out. If you had one question to Kate Quirk in the next earnings call, what would that be?
Hard to whittle it down to one, because I always ask her a fair few questions. Probably around the upselling component with the extra med, and how they're going to address that with the original NHS trusts they have. I think she would say yes, they're going to do that, but not obviously talk about it in limelight, because it's sensitive if someone from those NHS trusts was listening, because remember, this is all public money. So I think I would ask surrounding that and pricing and how they're going to do that.
Yeah.
Work board, I just got it up now. She did purchase shares, 1.5 million back in March last year. So just was at the bottom. Yeah. So she did put her own money in.
Yeah, exactly. And I think my question to her would be regarding the market landscape, like how competitive it is, and just to ask her, does your competitors own NHS trusts that you don't have already and that you plan on growing towards? And do you have to buy them out? I think that would be my question, because usually when NHS trusts sign any deals, they have a good relationship with whoever they sign. They don't sign for anyone, like randomly.
Yep.
And usually you have to buy them out in order for them to, for you to win that trust. So my question would be, do you have to, in the future, have to buy them out, or can you still outcompete them and win that contract with a better offering? That'll be a very interesting question. I'm not sure if she she'll let us know further details on that, because she'll probably try to say, oh yeah, we're not going to acquire yet. We have plans for acquisition, but we're not going to let the market know.
I think that also, yeah. In the
That sort of
past,
thing.
that's what they've said to me when I've asked questions, which is, fair enough. Don't want to cross the line there.
Yeah, cool. So let's move on to the third topic, and this is an interesting one. This is what I chose. This is not what Reese chose. This is Investor of the Week. And you know what? I'm going to give Sly Meat from Strawman the benefit of the doubt. And I even followed him, as you can see in the screenshot right there. I followed him because I think it's one of the most amazing way of investing I've ever seen. He buys companies that are in the R&D phase at a very low valuation and then holds it through. And if you look at his portfolio in Strawman, you have it like Imugene, which is a cancer, like a biotech company that, see, even I do not know exactly what they do, but I know that they provide a very valuable service in the biotech, trying to have a cancer therapy. And I think something along those lines, and they have a great technology, and it has passed the trials, I think, and now they're going to do commercialization. But he has that. And then he even has Strategic Elements, which is a government venture-backed subsidiary. And I think it's a very cool subsidiary, because I actually read that if you own Strategic Elements and if you make money in terms of capital gains or in the form of dividends, the capital gains tax is $0, because it's an Australian government venture-backed subsidiary.
Oh, that's interesting. Yeah, I didn't
That's
know
why I was
that.
thinking, I was like,
No
holy
way.
crap, this is really cool. I'm like, the stuff he invests is quite like fascinating. And then obviously
Yeah.
we talked about Alcidion. I mean, Alcidion we all own now. But then obviously the key discussion point in his portfolio is BrainChip. This guy invested at a very low valuation, not very low valuation, but at a low valuation.
Midpoint. Yep. Yep.
He's done pretty well at it, but he's been posting a lot in Strawman with BrainChip and saying how great Akita's chip is and how great the breakthroughs are. And I think he's a fascinating investor to talk about, because I think he deserves, in my book, to be part of Investor of the Week. He's ranked number 4th in the community. And I think he provides a very unique insight into how to invest, which is not what I do with my investing, not what you do with your investing, Reese. But I think there is something to learn from him, because he got a 10 bagger with Imugene. Like, did we? No, we didn't. So
Yeah.
what do you think some of the aspects of his investing that appeals to you?
Probably his returns in the first place. Like, he's got a 10 bagger and I don't, so there's that. Yeah, as you said, it's very, very different from how I would invest. Number one, I don't invest in ASX because I don't have that background and I don't know what I don't know. And then there's some other reasons around that, but also being very concentrated. As you can see, he's only got a handful of stocks there, 1, 2, 3, 4, 5, 6 stocks. And Imugene being half a portfolio, he must have a lot of conviction on it, even still after it's 10 bagged, which is phenomenal. If he thinks if this thing pulls off, his portfolio will be through the roof. So you can't grumble with those type of returns. In terms of risk-adjusted returns, it would be a lot lower because obviously he's very concentrated in that one stock, but he's done incredibly well out of it. So kudos to him because he's done a lot better than I have. Obviously in Alcidion, he's been in that since 20 cents, which is a stock we've just spoken about. BrainChip, it's not something I'm a fan of, just on valuation grounds. I don't understand, again, the Akita chip and all the technology. I understand, from what I do understand, it's a fantastic piece of technology, but when I looked at the numbers, that's what I've been taught to do as an investor, and I've never seen a bigger red flag on the numbers side. 1 billion valuation, and the company's not actually got any revenues yet. So, I don't know what I don't know, and therefore I'm not going to sit here and flag them off. But just from how attractive they've been to a lot of people on the platform, not really for me. But he posts a lot, Slimate. This guy's a great contributor, so just got to say thanks for that. And keep doing what you're doing, because at this rate you're going to be a billionaire.
Yeah, absolutely, mate. And what I really find fantastic about is brain chip analysis, because I did invest in brain chip. Fun fact, I did invest in it 4 years ago when I first started out investing in stocks.
Oh yeah.
It was my third investment, and my first two were Afterpay and Appen. So talk about luck of the draw, and talk about me
Buggers.
when I first started investing, when I first got into uni and everything, and I sold out like a year or two later because I didn't have a long-term time horizon. I did not understand anything about investing. I just thought they were really fun companies. And with BrainChip, I know a bit where what they're really, their real key technology, from my understanding, is when you do deep neural networks for like machine learning, it's very time consuming, as well as it takes up a lot of processing power. And the way normal machine learning is done is through the cloud. But even when you do it through the cloud, it just takes forever for your machine learning to like learn. So when you do, I mean, this is perhaps something easy to understand if you code, but I tried a bit of coding just for lols. And I was putting in a machine learning model, and it took me like 5 minutes for the model to input something, like to get an answer, or whether or not my model worked or not. And what they're doing is they're saying, no, you don't have to go through a server. We'll just put it at the edge so that it just trains quicker. So
Yep.
that in itself is a really cool technology. That's why I picked BrainChip in terms of the patent and the R&D is like, it's right up there. And there are people who have, the previous CEO had a lot of experience in getting the patents out of the way. But now they claim that they can mass commercialize, and that I don't agree with. I feel that it takes a while for them to commercialize. And funny enough, in one of their latest investor presentation deck, I saw a slide where they told investors, I think they were not meant to tell investors, but they show projections on the Akita sales. And it was just like 100, 150, 200, 350, and then like 3,000 in like year 20, or like 2025, sorry. So that in itself is kind of a red flag, because they're letting everyone know that when it comes to commercialization, it's going to take a while before the sales come. So it's not a guaranteed. And even though they have agreements with TSMC and Socionext, we have currently globally, we have the chip shortages. So I do not think they have time to like put in a new chip, especially when there's a shortage. They need to make as many chips as possible for everyone. So that in itself is a big risk, but kudos to him. He made his return. Hopefully it does well for him. And it sticks with his bio. He says, I like researching new technologies, finding small companies, doing R&D in these areas, and incubating investments in them for a few years. So he's all about the venture investing and investing at a low valuation and holding for a long period of time. Finally, we'll talk about lessons of this week. This is my lesson of this week, and it's Zuno. And it's a company that I owned. And in 8th of June, which is this week, they put out an announcement that really it's like someone put a dagger in my heart and then just twist it as well, just to see how I bleed. And I bleed pretty much because this is not how investors should be treated, especially when the founder CEO said that he's not going to sell stock at double the valuation, and then he ended up doing it a year later, which I think is a massive red flag. And that's not how you should treat your shareholders, because if you tell them one thing and you do the other thing, that's not how proper CEOs manage. So he decided to sell 7 million shares to Regal Funds and another UK-based asset management firm. And Regal, please bear in mind, they have a very bad history. And I find it insulting that they call Regal as one of the top fund managers. Like, the reason why they're top is because they're short everything and they make money from the short. They don't make money from the longs. They make money from the shorts. So when I see that Regal gets more stock and they get the opportunity to short as well, like as a bonus, I'm thinking, holy crap! Like, I'm gonna like stay away from this company for a while, because those guys are responsible for shorting the stock. That's why the share price went down as well. And the fact that he in the third paragraph he says he has no plans to sell any more shares. I doubt that. He might sell more because the average price for his shares are around 8 cents. So if it were to like halve even at like 30 cents or 25 cents, he can still sell and make a profit. You know what I mean? So that's why I really do not trust management anymore. Even though in my Strawman post, I talked about how the AFR hit piece was like, it's just me protecting the company because I feel like there might be reasons as to why, this could be like a one-off thing and it shouldn't really be taken seriously. But obviously I made the mistake and I should have known better that there are some conflict of interest here. And all of this just hurts the shareholder. And at this stage, I just want to reduce my weighting in Strawman. Just get it out of the portfolio slowly. But yeah, and the funny thing is, the reason why I talk about lessons from this week is you also invest in Zuno, and I saw that you also have a very bold thesis on it. So I want to see what your take of this latest announcement is.
Gee, way to rub it in. Yeah, I bought on the way up. No, I didn't research it properly. It was one of my first proper investments with serious money. And looking back, I didn't do the research. So I'm not going to sit here and say I got it completely wrong because I didn't know what I was really doing. But the one thing that I would summarize is, and you hit it on with the management as well, is that every time these guys put out a 4C, he was reporting on a different metric each month, each quarterly. That's just the biggest red flag you can get in terms of management. He couldn't stick. It went from sales invoiced, cash receipts. I'm thinking like, you got to stick to the story here, fellas. And looking back, that was that from the start. I mean, getting the actual pandemic thing wrong and everyone mass producing hand sanitizer, that's a different story. But when you talk about management, I think that them not having the same backstory in terms of reporting to market and not very being upfront with the trials in the UK when the 30-day trial got taken down for Zuno. A lot of things regarding that, they weren't very upfront with investors. I'd rather you just tell me the bad news to my face and don't cover it in bullshit. I just want to know. And, as an owner of the company, I wasn't entitled to that information. And therefore I was a bit disappointed, and looking back and seeing the share price performance and the business performance, not massively surprised, and I wouldn't go near it. Now it's trading on a very, very thin, very low multiple, but I think that's a value trap really, maybe, because I can't imagine these guys, making 60 million in a few years' time when COVID's kind of over. They obviously pay a dividend, fully franked dividend, I believe, and I believe
I think that
pretty high.
I'll stop you there. I think the dividend was for the shareholder. For the founder, because he owns 40% of the company. So dividend went straight to his pocket. That's what some people are saying. And you know what? I actually agree. Because if you own 45% of the company and you pay a dividend, that 45% is for you. The other 55% is for everyone else.
Yeah.
And, that's why I was just thinking, now he'll probably not pay a dividend, right? So if he doesn't pay a dividend, then what are investors really getting out of this? And I think it's just a bad communication to investors, just very bad actions. Because some CEOs lie, and that's fine. Some CEOs can say whatever they want. But if they're consistent, then investors have at least some sort of certainty on the way the company themselves.
100% agree.
Yeah, so that way we can make decisions ourselves. But the fact that this CEO and this company in general just goes back and forth like a tabletop with whatever they want to say, it just made me go, that's it. That's the last straw. I'm not going near it. And also regarding their contracts even. And that's why what was funny was that I probably, I should have known this, because in my previous Strawman updates, I talked about how you said that they reported a different metric in every 4C. And one of the metrics that I try having difficulty understanding is the sales invoice and then how it converts to cash. Because when I was reading through the fine print in Zuno, they have 90-day policy to get. And I thought, okay, I'll check the 4C from 2 or 3 quarters ago, because they just won some contracts, right? Like 2 or 3 quarters ago, and I wanted to know exactly how much of those invoices that they won, like how much of those contract wins they won, and how much of it has turned to cash, because it should be turned to cash now, right? And then I see I see the same number. I'm like, hang on a minute, did they like not win did they not get the cash? That's like literally written in the contract where the entity has to pay 90 days, right? And then I realized that this may be the Saudi Arabia entity, because you know how they have distribution agreements with like the other guys in MENA, like Middle East and North Africa region. He won those contracts, but because they're not getting the cash, it just comes to my mind, like, can they actually get money out of Middle East?
Anything? Yeah.
Can they? Because I feel like another lawsuit is on its way, or like it's getting, conjured up, because these guys have a reputation of going to lawsuits, but we're not getting the cash as investors. So what's going on? That's why a lesson from this week is about looking at the telltale signs in the beginning and making a decision when you start to see the ship. It's like the Titanic going down the sea, and being very proactive, because I was very late with my reaction, and now it's just a bit too late for me. So hopefully, I lost 40% of my investment in Strawman. So I'm gonna take the hit, bite the bullet. I'll have a bit of an investment still in Zuno, because the valuation is actually like, I didn't even stretch the valuation with that I did for like 2025 onwards with my assumptions. And I got to $1 in terms of the valuation. And I just thought, okay, because the valuation is so low, I'll still keep a little bit, because the market always goes up and down. So, but that's a really powerful lesson is, when it starts to not smell right, you have to make a quick decision. Otherwise, you're gonna end up paying for it later. And that's what I face. And that was my lesson for this week. Mr. Reese, did you have your lesson for this week?
No, I think I could definitely take a lot from your lesson in the same research and management, because I own Zuno, and I'd learned a lot through this. And I stopped following it after I sold my shares because I was very irritated. And for you to come back and we talk about this information is pretty important to me, because I was also I'll say a victim. I'll say I didn't do my research, and so basically the lesson we learn is just do your research on management. Go on Hot Copper, go on Strawman, have a look what people are saying, because if you're not going to do it yourself, you can maybe even cut the time down and see what other people are saying. You're obviously best to do it yourself, but you can pick up these things pretty quickly, and that's what Strawman is a perfect platform for.
I agree.
Learn this information from you or I writing about it, watching this video. It's someone that was going to research a company that's on a 6 times price to earnings multiple. There's got to be a problem. Yeah, well, here it is, and we're telling you why. So
yeah. So before we wrap it up for our first inaugural podcast of the week for Strawman Weekly, I want to ask you one question to end it off with. What is one stock that's in your horizon and in your radar that you're doing research on, and why?
So I'm looking at Scroll Group right now, which is a tiny company. I think it's like, what's the market cap? 1 second. Very tiny company. It's 20 mil market cap, maybe even less. They do a SaaS platform for hiring teachers and HR. So I'm just doing some research on them. I think they've signed a deal with Faria, which is there's got a lot of potential there. If they get this half right, the stock could be rated a lot higher than it is today. So that's what I'm researching. Got to ask the same question back to yourself.
For me, the one stock that I'm looking into and I'm doing a lot of research into is PointsBet, because there's this guy in Strawman called Chalky that keeps on talking about PointsBet every day and writing about a piece on PointsBet every day, or based on whatever happens in the North American market or in the Canadian market, or even in the betting market in general, and what's PointsBet's doing. And he's talking about how great the stock is, but he hasn't invested himself. I just wanted to see what's the big deal. Like, come on, the company is growing triple digits in revenues, which I think is fantastic. But is it really worth the valuation that they have right now? I mean, they have signed so many deals with the NBC, and they're expanding like wildfire in America. But is it sustainable, or does it come back to shareholders in some way or form? Looking at competitors like DraftKings, I think is quite useful for me as well, because DraftKings is a key competitor. And even in Australia, Sportsbet, right? Everyone uses Sportsbet or Ladbrokes for betting.
Mm-hmm.
So what's the special thing about PointsBet? Like, and I know they are really into advertising in terms of marketing. They hire, Instagram influencers.
Yeah.
And who not, you have Tiger Woods playing, that costs money, but that could bring in the views. So it's a very interesting industry, betting industry as well. I know it's not ESG because it's very good in terms of the governance protocol, because you have all these issues, but it's still a very interesting company to analyze and see how they go. But yeah, so hope you guys enjoyed our first inaugural week on Strawman. I hope you guys enjoy this content. Hope you found something very useful, learned something about companies that we're passionate about and the companies that we do a lot of research on. And we choose a podcast platform as a way of doing it, because you can only share about 200 words of the research in Strawman, but you don't really get to see our decision making. It's kind of hard to put everything into words. And I hope you guys enjoyed this first week in Strawman Weekly. Take care.